Something extraordinary is happening in the Middle East right now, and it's creating one of the most significant Bitcoin price anomalies in the history of cryptocurrency. While Bitcoin trades at approximately $95,000 on major Western exchanges like Coinbase and Binance, peer-to-peer traders in Dubai are moving coins at $114,000, a jaw-dropping 20% premium that reveals a crisis in the international banking system that nobody is talking about. This isn't speculation. This isn't market manipulation. This is the direct result of Western banks systematically cutting off cryptocurrency access to the Middle East, creating a supply shortage so severe that desperate buyers are willing to pay premiums that would be impossible in a functioning global market. Over the past 6 months, a quiet revolution has been taking place in the banking corridors of New York, London, and Frankfurt. Major international banks have been systematically terminating relationships with cryptocurrency exchanges and payment processors that serve Middle Eastern customers. The official reason: compliance concerns. The real reason: a coordinated effort to control crypto flows into a region that Western financial institutions no longer fully trust. Binance, the world's largest cryptocurrency exchange, quietly restricted services to UAE customers in August. Kraken followed in September. Even cryptocurrency-friendly institutions like Silvergate and Signature Bank, before their spectacular collapses, had already begun limiting wire transfers from Middle Eastern accounts. The result is a financial blockade that's choking off the primary channels through which Bitcoin flows into the Gulf region. For traders in Dubai, Abu Dhabi, Riyadh, and other major Middle Eastern financial centers, this creates an impossible situation. They can see Bitcoin prices on international exchanges. They can access the internet and view real-time market data. But they cannot easily move dollars through the banking system to purchase Bitcoin at those international prices. The traditional on-ramps, bank wires to exchanges, credit card purchases, payment processor transfers, have been systematically dismantled. In a normal, functioning market, a 20% price difference between regions should trigger massive arbitrage activity. Traders should buy Bitcoin at $95,000 in New York and sell it at $114,000 in Dubai, pocketing $19,000 per coin while simultaneously closing the price gap. This arbitrage mechanism is supposed to keep global prices aligned within narrow bands, typically just 1–2% to account for transaction costs and regional factors. But that arbitrage isn't happening because the very banking restrictions creating the premium also prevent the arbitrage that would eliminate it. You cannot efficiently buy Bitcoin in the United States and transfer it to Dubai buyers if those buyers cannot send you dollars through normal banking channels. The blockade is self-reinforcing. It creates the premium, then prevents the market mechanisms that would naturally resolve it. The situation on the ground in Dubai reveals the extent of the crisis. Local Bitcoin traders operating through Telegram groups, WhatsApp networks, and in-person meetings are the only remaining liquidity providers. These peer-to-peer traders take enormous risks, meeting strangers with cash, managing cryptocurrency wallets, navigating unclear regulatory frameworks, and they're charging premiums that reflect those risks plus the fundamental scarcity of supply. What's happening in Dubai isn't just about Bitcoin prices. It's about the emergence of an entirely parallel financial system. With banking channels restricted, traders have reverted to the oldest form of value transfer: physical cash. Briefcases of dirhams and dollars now change hands in hotel lobbies, luxury car showrooms, and private offices across Dubai. The Bitcoin transfers happen digitally, but the payment happens in physical currency. This cash-based system operates outside the surveillance apparatus of international banking, which is precisely why it's both necessary and controversial. The premium reflects not just Bitcoin scarcity, but the premium buyers must pay for anonymity and banking system independence. A 20% markup suddenly seems reasonable when the alternative is complete exclusion from cryptocurrency markets or submission to invasive surveillance and arbitrary restrictions. The question many Western observers ask is, why would anyone pay a 20% premium for Bitcoin? The answer reveals fundamentally different perspectives on value, risk, and the future of money. Wealthy Middle Eastern families and businesses see Bitcoin as a hedge against regional instability and currency risk. For a Saudi business owner concerned about Vision 2030's economic restructuring, a 20% premium to move wealth into bearer assets outside the traditional banking system is not expensive. its insurance. The 2008 financial crisis, subsequent sanctions regimes, and arbitrary account freezes have taught many in the region that Western banks are unreliable custodians for significant wealth. Bitcoin offers an alternative that cannot be frozen, seized, or blocked by New York bankers. Despite official statistics suggesting modest inflation, those living in the region report cost of living increases far exceeding official numbers. Real estate prices in Dubai have surged. Import costs have risen. Bitcoin, with its fixed supply, offers protection that local fiat currencies cannot. Many in the younger Gulf generation see cryptocurrency as aligned with their vision of technological progress and independence from Western financial hegemony. They're willing to pay premiums to participate in what they view as the future of finance. The banking restrictions creating this premium aren't random. They're part of a broader geopolitical strategy. Western financial institutions and their regulatory overseers view cryptocurrency as a potential sanctions evasion tool, a money laundering risk, and a threat to dollar dominance. Middle Eastern crypto adoption represents all three concerns simultaneously. The Gulf states have been attempting to reduce dollar dependency for years, conducting oil transactions in yuan, building alternative payment systems, and exploring central bank digital currencies. Cryptocurrency adoption accelerates this de-dollarization trend while making it accessible to individuals and businesses, not just sovereign actors. From the Western banking perspective, restricting Middle Eastern crypto access serves multiple objectives: maintaining sanctions effectiveness, preserving anti-money laundering controls, and slowing the erosion of dollar-based payment networks. The 20% Dubai premium is the price of these geopolitical goals, paid by ordinary users caught in the crossfire. While direct Bitcoin purchases face restrictions, one cryptocurrency has emerged as the workaround: Tether, USDT, the dollar-pegged stablecoin. Tether trades relatively close to its $1 peg even in Middle Eastern markets because it serves as the intermediary currency for Bitcoin purchases. The flow works like this. Middle Eastern buyers purchase Tether through peer-to-peer networks using cash or informal banking channels. They then use Tether to buy Bitcoin on exchanges that accept it. This two-step process adds friction and costs, contributing to the overall premium, but it provides access that direct purchases cannot. However, even Tether access is under threat. Western regulators are increasing pressure on Tether's banking relationships, and future restrictions could close this remaining on-ramp, potentially pushing Dubai's Bitcoin premium even higher. Dubai's situation mirrors dynamics that emerged in Hong Kong during 2019-2020, when political protests and subsequently COVID-19 restrictions created banking access issues. Bitcoin premiums in Hong Kong peer-to-peer markets reached 5–10% above international prices as locals sought to move wealth outside channels potentially subject to Chinese government control. The Hong Kong premium eventually subsided as alternative payment channels emerged and some banking restrictions eased. But Dubai's situation appears more structural and longer-lasting, suggesting the premium could persist or even increase. Notably, Hong Kong's crypto premium peaked at around 10%, half of what Dubai currently experiences. This suggests Dubai's situation is twice as severe in terms of banking access restrictions and supply scarcity. Adding complexity to the situation is regulatory uncertainty in the UAE itself. While Dubai has positioned itself as crypto-friendly, establishing regulatory frameworks and licensing cryptocurrency businesses, the gap between official policy and practical banking access creates confusion. The UAE's Virtual Asset Regulatory Authority, VARA, has licensed numerous crypto firms, suggesting government support for the industry. Yet these licensed entities still struggle to maintain banking relationships, both locally and internationally. Local UAE banks, concerned about correspondent banking relationships with Western institutions, remain cautious about servicing crypto businesses despite regulatory approval. This creates a paradox. Crypto businesses can obtain licenses and legal recognition, but cannot access the banking services necessary to operate efficiently. The result is a licensed but effectively underground industry serving customers through peer-to-peer networks rather than traditional financial infrastructure. The 20% Dubai premium creates enormous profit opportunities for those positioned to capture it. and reveals who holds power in this new financial landscape. Peer-to-peer traders, the individuals and small networks moving Bitcoin into the region, are earning extraordinary returns. A trader who can reliably source Bitcoin internationally and deliver it to Dubai buyers can generate 20% returns per transaction, gains that dwarf traditional financial services. Hawala networks, traditional Middle Eastern informal banking systems based on trust and networks, are adapting to cryptocurrency, providing the payment infrastructure that formal banks won't. These networks charge fees that contribute to the overall premium. Insider access, those with maintained banking relationships, whether through corporate structures, offshore accounts, or personal connections, can conduct arbitrage that others cannot, extracting value from the price discrepancy. Exchange operators, crypto exchanges willing to serve Middle Eastern customers despite compliance challenges, command loyalty and volume, though they face constant pressure from banking partners and regulators. Several potential futures could emerge from this situation. Western banks could reverse restrictions, restoring normal crypto access to the Middle East and allowing arbitrage to eliminate the premium. This seems unlikely given the geopolitical drivers behind current policies. Further restrictions could push premiums higher, potentially reaching 30–40% if Tether access closes and peer-to-peer networks become the only option. This would create a fully parallel Bitcoin market in the region. New payment rails, decentralized exchanges, and non-Western banking relationships could provide alternative access, reducing but not eliminating premiums. This represents gradual adaptation rather than resolution. UAE or other Gulf governments could establish state-backed crypto on-ramps, either through sovereign exchanges or central bank digital currency bridges. This would eliminate premiums but increase government visibility into crypto holdings. The Dubai premium tells us something profound about Bitcoin's value proposition. In a truly global, permissionless system, regional premiums shouldn't persist. The fact that they do reveals Bitcoin's ongoing dependence on traditional financial infrastructure for fiat currency conversion. Bitcoin can move freely across borders. The blockchain doesn't care about geography. But Bitcoins are only valuable when they can be exchanged for goods, services, or fiat currency. That exchange still depends on banks, payment processors, and regulatory-compliant infrastructure. Control those choke points, and you can create regional price variations despite cryptocurrency's theoretical borderless nature. Yet the premium also demonstrates Bitcoin's value in the face of financial exclusion. That Middle Eastern buyers pay 20% above international prices proves they find value in Bitcoin that exceeds its dollar-denominated price. They're not buying Bitcoin at $114,000. They're buying financial independence, censorship resistance, and alternatives to a banking system that has explicitly rejected them. The Dubai Bitcoin premium isn't just about cryptocurrency. It's a signal about the fracturing of the global financial system. When regional premiums of this magnitude can persist in major financial centers, it indicates that the integrated international banking network is no longer functioning as seamlessly as it once did. This fragmentation serves geopolitical purposes for Western powers, but creates opportunities for alternative systems. Every person who pays a 20% premium for Bitcoin in Dubai is voting with their capital against the current system, and for an alternative, regardless of how imperfect that alternative currently is. The premium will persist until either banking access normalizes or alternative infrastructure matures. Given the geopolitical forces at play, neither resolution appears imminent. Dubai's Bitcoin traders have built a parallel market, and that market is here to stay.